Hello friends, I am going to present a video on contract costing. Contract costing is a specific order costing where work is performed as per the specification of the customer, as per the requirement of the customer, and this work is performed at site, means outside the factory, and it is a specific costing for every contract. It's a separate cost unit. For each and every contract, we prepare a separate contract account. Either it may be numbered or the location of the contract may be specified. Delhi, Chennai, Mumbai, whatsoever is the location of the contract, that location may be satisfied or it may be numbered by the contractor. So we'll see how the expenses are recorded, how the income is recorded. This contract account is usually prepared for 1 year. If contract is of short duration, it may be for a lesser period. But if contract is of longer duration, 2 years, 3 years, 4 years, then at the end of each year, we prepare contract account. This contract costing is applicable in construction work, in engineering works, in shipbuilding, etc., where the contracts are of long duration and performed at site, not inside the factory. So first of all, we'll see how the costs are to be charged, how the costs are to be debited, and how the income is to be credited. So first of all, the material. Material at site in the beginning. If a contractor commenced business in this year, then this material at site will not be there. But if contract commenced in the preceding years, then material at site in the beginning will definitely be there. So whatsoever is material lying at the site, it may be sand, it may be bricks, it may be cement, it may be steel, whatsoever material is lying at site, all materials are included in this. Then material purchased from vendor during the year. So whatsoever material is purchased from vendors, that will be recorded. Then material may be transferred from stores. That means from the godown of the contractor, if material is lying from there, if material is shifted to this particular contract, that will also be debited. Then it may be the material transferred from other contracts. If material is transferred from other contracts to this particular contract, that will also be debited. For example, material may be shifted from contract number 701 776 to this 777 contract, then material will be debited to this particular contract. So these are the sources of material for the year. Out of this material, if any material is returned to supplier, then that will be credited. Material returned to supplier or the vendor, then whatsoever material is returned to store return to stores, that will be credited. Then whatsoever material is shifted from this contract to other contracts, that will be credited. Transferred to other contracts, that will be credited. If any material is destroyed during the year, maybe by fire, by accident, maybe stolen, then whatsoever is the cost of the material stolen, that will be material stolen. So whatsoever is the cost of the material stolen, that will also be credited because that is not consumed for this particular contract. Then material may be sold. So let us suppose if material costing 10,000 is sold for rupees 8,000, then whatsoever the loss we suffered, that will be credited to contract account. Actually, we want to reduce the cost of the material sold. Cost of the material sold is 10,000. We want to reduce that cost from this contract because that is also not used for this particular contract. So that is why the cost is credited. It may be 7,000 and 3,000. It may be sold at a profit. If sold at a profit, say costing 10,000, sold for 12,000. 12,000 will be the sale of material and 2,000 will be the profit to be debited to contract account. Ultimately, 10,000 cost is to be credited. Then whatsoever material at site at the end of the year is left, that material will be written here. Difference of these items is the cost of material consumed on this particular contract during this year. So this is the cost of material, all debited minus all credited is the cost of material consumed on this contract during the year. So this is how we record the cost of the material. Material may be sand, maybe cement, maybe bricks, maybe steel, maybe anything else, whatsoever the material is consumed. Then direct labor. Direct labor paid plus labor charges payable. Both will be debited during the year, whatsoever the labor we have paid and whatsoever relating to the year is still payable, that will also be debited. Then there may be certain overheads. Overheads may be the indirect expenses. Majority of the expenses are direct one, directly related to this particular contract. But some of the expenses may be indirect expenses. Head office cost may be little bit cost may be charged to this particular contract. Supervisor salary, which is supervising this particular contract, that may be debited, a portion of that may be debited. So indirect expenses are the proportion of expenses linked to this particular contract may be debited. Then there may be other direct expenses relating to the architect fees, the surveyor's fees, or electricity charges, the electricity which is consumed there, all are the direct expenses. Then there may be the cost of subcontracts. The contractor may give other contracts regarding marble, maybe sanitary, maybe painting, maybe others to the other contractor. Whatsoever amount he'll be paying to the other contractors to complete the sanitary work, to wooden work, or to other painting work, paints work, etc., all will be debited to this particular contract. Then there may be cost of extra contract or cost of extra work. Sometime suppose a contract entered into is for 20 lakh, but afterward some enhancement is made. In the contract terminology, this is called enhancement. Work may be enhanced, that the annex is to be prepared, cycle shed is to be prepared, scooter shed is to be prepared. The work may be enhanced, which was not there in the original work. So then, whatsoever the cost of extra work is there, that will also be debited. Then there is a plant. Plant means any type of machinery which is used on the site. It may be crane, it may be a mixture, it may be something else. Different type of machinery is used in the at the site. So whatsoever plant or machinery is purchased, we will be considering it from two angles. One we will call it as general plant, one we will call it as specific plant. General plant is one which is not purchased specifically for this particular contract. Contractor has it, but he has not purchased specifically for contract number 777. Wherever he is in need of, he carries that machinery, that plant there, uses for a certain period, for 1 month, 2 months, 3 months, longer, shorter period, and then he carries it to the his own godown, own warehouse. That is called as a general plant. With regard to general plant, we will write only the depreciation. We will not write the cost of the plant purchased. This is when plant is purchased specifically for this very contract. When we are given the cost of the plant purchased, then we will treat it as a specific plant. We will treat it as a specific plant. No doubt, with regard to specific plant, again, our motive is to provide the depreciation only. But the way of recording depreciation is a different one in case of a specific plant. So first we'll discuss specific plant treatment, then we'll discuss with regard to general plant. So plant purchased say for rupees 10 lakh, and its date is also given, and its date is very relevant. Suppose we are preparing it for 24-25, and we purchase the plant in the very beginning of the year. Out of this plant, suppose a plant costing rupees 50,000 was sold on say 30th of September for rupees 30,000, costing 50,000. sold for rupees 30,000. Hence there is a loss. But in case of fixed assets, the profit or loss is calculated not by comparing the cost with the sales value, but by comparing the written down value with the sales value. In case of material, we compare the cost with the sales value. But in case of assets, it is the written down value and the sale. Difference of the two is the profit or loss. So that means we have to calculate the value, written down value of the plant sold. Its cost was 50,000. Rate of depreciation will be given to us. Say rate of depreciation is 10% per annum. The rate of depreciation is 10% per annum. So we will calculate the written down value. Okay. Cost 50,000 less depreciation for 6 months less sales value. That will be the profit or loss. On 50,000 at the rate of 10% for 6 months, the depreciation will be 2,500. So that means 50,000 minus 2,500, 47,500 is the written down value. So that means plant of the written down value of 47,500 is sold for rupees 30,000. So that means there is a loss of 17,500. This is how the profit or loss is to be recorded. You just see, purpose is not to write the value of plant, purpose is not to write the sale, purpose is not to write the loss, purpose is to write the depreciation. Depreciation on the plant which has been sold. That plant includes in this is worth rupees 50,000. 50,000 is included in this. 47,500 is credited. So 50,000 debited, 47,500 credited. That means 2,500, which is the difference. That is the depreciation on the plant sold during the year. Depreciation. So we want to record only depreciation. It may be a general plant, it may be a specific plant, but the way of recording the depreciation in the specific plant is different from the depreciation recorded on the general plant. Similarly, if any plant is destroyed, any plant is sold, again we have to calculate its written down value. Suppose this plant is stolen on 31st December 2024. Its cost was 60,000. So if its cost was 60,000, so that means we used it for 9 months. We used it for 9 months. So on 60,000, we will calculate the depreciation for 9 months and we will deduct from the cost. That will be the written down value, and the written down value is the loss. Written down value is the loss, cost is not the loss. So in case of fixed assets, it may be the asset sold, it may be the asset destroyed. We have to find out the written down value in order to calculate profit or loss. So in this case, 4,500 is the depreciation. So 60,000 minus 4,500, so 55,500 is the loss of the machinery stolen from the site. Then plant at site. So whatsoever plant is left at site, Okay. So we had a plant worth rupees 10 lakh, costing 50,000 was sold, costing 60,000 was stolen. We were left with a plant costing 8 lakh 90,000. On that, we will provide a 10% depreciation, which comes out 89,000. So after 89,000 depreciation, 8 lakh 1,000 is the return on value which we are to record here. So 8 lakh 90,000 included in this. 8 lakh 90,000. 8 lakh 1,000 recorded on this side. Difference is 89,000. That is the depreciation. 55,500 on this side. 60,000 included in this. 60,000 minus 55,500 is the 4,500 depreciation on the plant stolen. 50,000, 47,500, 2,500 is the depreciation. So depreciation on the plant sold. So this is how we are to record the depreciation, but the way of recording the depreciation is different one. So 10 lakh minus these values is the depreciation. Depreciation of the plant which was used on contract number 777 during the year. Then depreciation on general plant. General plant will be the one for which we are not given the cost of purchase when it was purchased. We are simply given its cost, its period for which it is used, and the rate of depreciation. But when it was purchased, that is not known to us. If that is not known to us, that will be taken as general plant, where we are given the plant purchased and its date also during the year, that will be treated as a specific plant. So general plant, say 5 lakh, cost is given, rate of depreciation, let us suppose again it is 10%, and we use for 3 months only on this particular site. So then that means 12,500 depreciation will be provided on this. So this is how the expenses are to be recorded. But in cost accounting, certain expenses like fines and penalties, we don't record it. These are financial expenses recorded in financial accounting only, not in cost accounting. In order to find out the true profit from the contract, the fines and penalties, if given in the question, that will not be debited to the contract account. Now we discuss the contract account in two parts. One, when contract is complete. Second, we will discuss when contract is incomplete on 31st March 2025. If contract is complete on 31st March or before that, then we will pass the entry contractee account debit to contract account with the contract price which will be given to us in the question. With the contract price, let us suppose the contract price is 20 lakh. So with contract price, entry will be passed, contractee will become a debtor, contractee's account will be debited. Difference of the contract account will be the profit or loss during the year. So if profit, it will be transferred to profit and loss account. So this is a profit. If loss, by profit and loss account. So wherever the difference comes. It may come on the debit side, it may come on the credit side. If credit side is bigger, it will be a profit. If debit side is bigger, it will be a loss. Again transferred to profit and loss account by profit and loss account. So this is how the profit or loss is calculated in case of a complete contract. If contract completed on 31st March or prior to that, on any date when it is completed and contract is completed, then contract will be debited and profit or loss will be calculated. Thank you very much.